Hi everyone, thanks for joining us. My name is Chris Ashton. The title for today's webinar is Essential Risk Management Tools for Traders. Now, as I'm sure many of you have experienced, March has been a particularly volatile month for trading CFDs due to the impact of President Trump's trade tariffs and spending plans, worries about the strength of the US economy, geopolitical developments, and the potential era-defining news that Germany may be ready to change their laws to unleash billions of euros for spending on infrastructure and defence projects. In this type of environment, without proper risk management, even skilled traders can suffer significant losses. Just before we move forward, a few housekeeping points for you to note. The webinar will last approximately 20 minutes long. There will be a Q&A section at the end, so feel free to add your questions to the Zoom chat or Q&A that you have access to. And please note that trading CFDs involves risk, and this session is for educational purposes only. It's not financial advice. On screen now for you is what I'll cover today. First up, I'll run through understanding the characteristics and drivers of volatility and market uncertainty. I'll move on to outline key risk management tools for traders. I'll follow this with a case study example of how to deploy a trading plan, including a risk management strategy from a market or CFD earlier in March. I'll then finish the presentation part of the webinar by highlighting the common mistakes for traders to avoid that can lead to unnecessary losses. Right, there's lots to pack in, so let's move on and start discussing why the markets that you've been trading in March have behaved the way that they have. Sometimes financial markets can seem like they're on a roller coaster, and that ride is powered by a mix of economic, political, and human factors. Usual characteristics of these type of volatile markets are rapid price fluctuations, sharp reversals and false breakouts, as well as a higher price sensitivity to scheduled and unexpected events. This all can have a psychological impact on traders. Volatility can be exciting, but it also tests emotional discipline. And when emotions take over, fear, greed, and hesitation can cloud judgment. That's why being prepared, having a structured plan, and solid risk management can be really helpful. So before we get onto that, let's briefly break down some of the main drivers of market volatility, along with some illustrative examples to deepen your understanding. First up, under macroeconomic influences, we have scheduled events, and these would be economic data releases, such as inflation numbers or employment figures, where markets can react sharply when the actual print that comes out diverges from the consensus expectation going into that print. A Friday non-farm payrolls release in the United States is a really great example of this. We also have central bank interest rate decisions, which are often accompanied by a press conference led by the head of the particular central bank. Here, actual changes to interest rates or hints at changes in the future, like we've had recently with the Federal Reserve, the ECB, or the Bank of Japan, can create uncertainty and force traders to rapidly reassess their positions. The good news is for you is that you can be prepared for these events. Plus500 provides you with an economic calendar, which you can check at the start of a trading day or trading week even, so you aren't caught off guard. And if you want to, you can do further research to understand more about the potential implications of these events for the CFDs that you may be trading. Next up is political events. Elections, referendums, or unexpected political decisions can dramatically alter investor expectations and lead to uncertainty. Two prime examples of this would be the Brexit referendum shock back in 2016, or more recently, the commitment by Germany's newly elected leader to the removal of what's known as the debt brake, which, if it happens, has huge spending implications for Germany and the Eurozone moving forward. Geopolitical tensions such as conflicts, sanctions, or trade disputes are also relevant, as they introduce uncertainty that investors try to price in immediately. The more unpredictable these events are, the sharper the market moves. So a sudden escalation in geopolitical tensions in a major region can, for example, cause investors to flock to a safe haven asset like gold. And we've seen gold go above $3,000 for the first time ever earlier in March. And this can result in a widespread dislocation across all markets. Other things that can happen are, more recently, a ceasefire in the Middle East or Ukraine has led to the reversal of some popular moves. We've seen oil moving from highs back at $80 in January down to 8-month lows around $65 in the middle of March. And you can see that move on screen right now. The final driver I wanted to discuss in this section is market psychology. I said earlier, markets are driven by fear and greed. And yes, human emotions play a significant role in market volatility. In times of optimism or euphoria, traders may build excessive positions, pushing the prices of more risky instruments to new highs. Bitcoin's move from $75,000 to the highs of all-time highs at $109,000 after President Trump's election win in November would be a good example of this. Conversely, fear can lead to nasty sell-offs, and the recent capitulation seen in the Nasdaq 100 index on fears about the disruptive influence of Chinese startup DeepSeek, and also that AI, artificial intelligence spending, may have peaked for now, shows what can happen when sentiment changes quickly. Both extremes can dramatically shift asset prices. There is also herd behavior to consider. This can lead to overreactions in the price of particular instruments. Traders often mimic the actions of others, leading to crowd dynamics where particular trends in certain CFDs can be amplified. This self-reinforcing loop can push prices far away from fundamental values before that correction sets in. Understanding all these factors that I've just outlined should help you grasp why markets are volatile. But if you can learn to identify the catalysts behind the market moves, it can help to inform your trading decisions and provide you with insights to develop strategies to manage these risks. So, with that as the backdrop, let's dive a little deeper into the core tools that every CFD trader, whether beginner or intermediate, can use to manage their risk effectively. These tools not only help to protect your capital, but also support disciplined trading when markets can swing unexpectedly. The first tool to consider is creating a trading plan. This is the blueprint for your trading. Its aim is to provide you with some structure, but also to provide you with something to fall back in when the markets are moving and you're under pressure. It promotes trading consistency and can help to prevent your emotions taking over. Now, a plan should include your trade idea, defined entry and exit rules, a clear risk to reward ratio, and preset loss limits to avoid emotional decision making. And I will build on these points further as we move forward. The next focus is capital allocation and your risk per trade. Capital allocation is about protecting your entire trading account from one single adverse move. Now, every trader is different. You have different risk tolerances, you trade on different time frames, and you have different trading goals. However, as a starting point for you to consider, I will outline the fixed percentage approach, although there are others that you can use. Following this approach, a general rule is that your risk per trade is around 1 to 2% of your trading capital. So, for example, if you have $100,000 in your trading account, and I pick this number as it's easy to follow, and you can scale this up or down depending on your own circumstances, your risk per trade is based on a calculation of $1,000 to $2,000. By following this type of approach, you don't wipe out all of your capital in one move, and you survive to trade another day, which is a key goal for any trader. Next up is putting some thought into your position sizing. Position sizing is the process of determining how many units or contracts to trade while balancing your risk and intended reward. It's a direct application of your capital allocation rules. Here is an example. I use a formula-based approach, although like with capital allocation, there are other approaches that you can use. So here, position size is equal to the amount you're willing to risk divided by entry price minus stop loss price. So if I take that into looking at the S&P 500, for example, if I'm willing to risk $1,000 and my entry price is 5,600 and my stop loss price is 5,550, the difference is 50 points. So I would have $1,000, which is the amount I'm willing to risk, divided by the difference between entry and stop loss price, which is 50, and that would equal to 20 contracts. Now, this formula can be adapted according to your individual trading requirements or limitations like margin, but it should also account for changes in market volatility. If your stop loss needs to be further away to account for bigger moves, or your capital allocation has reduced or changed, this formula would need to be recalculated. Moving forward, using stop losses are also an essential part of protecting your capital. A stop loss order, if you weren't aware of this, automatically cuts your position when it hits a predetermined price level, capping your losses. These orders are pivotal for trading in volatile markets where prices can reverse rapidly. They ensure that a single bad trade doesn't get out of hand. They provide an emotional buffer that helps to remove the stress of deciding when to exit a losing trade. And these orders can be set in advance on the Plus500 platform. Best practice when using stop losses is to place a sell stop loss just below a particular support level that you have identified in advance, or to place a buy stop loss above a resistance level that you've identified. It is not advisable to place stop loss orders at a random level based on arbitrary percentages or purely based on the amount that you can afford to lose, as you may get caught up in choppy price moves. I should say at this point that if you want to know more about charting support resistance and other technical analysis techniques, I recommend you go to the Plus500 YouTube channel and view the 2 webinars that I did last year on these specific topics. This will provide you a really good starting point from which to build your knowledge in this area. Now, moving on to back to stop losses, a trailing stop loss can also be used to help lock in any profits that you may have in a particular move, while giving your trade room to grow. It does this by adjusting the stop loss level as the trade moves in your favor. For example, if you had a long position, as the price of the instrument moves higher, the trailing stop loss follows behind at a defined distance defined by you in advance on the Plus500 platform. In this way, it offers profit protection, as if the price reverses, the trailing stop loss triggers an exit, thus securing earnings accumulated during that up move. However, I need to say, this type of order is not foolproof and offers no guarantees of a profitable outcome. It's just another risk management tool for you to consider based on the market conditions you may be experiencing at any particular time. Now, once you've defined your stop loss, you can start to look at where to take profit. Here, it can be beneficial to look at your risk to reward ratio. This is a comparative measure of your potential loss versus the potential profit from a trade. To calculate this, you divide the potential profit by the potential loss, and that gives you a ratio. As a general rule, you are looking for this number to be higher than 1 to 1, but ideally, you want it to be 1 to 2 or higher. And that means that 1 to 2 means the potential gain is 2 times the amount that you're risking. As you can see from the table on screen, a favorable risk-reward ratio ensures that your cumulative profits outweigh the losses when applied to a series of trade, even where a trade success rate may be less than 50%. Once you've accounted for the risk-reward on a particular trade, you can consider setting your take-profit orders. Take profit orders can be set into the Plus500 system in advance, like stop loss orders, and they automatically lock in gains when the market reaches your favorable level. These orders give you a predefined exit, ensuring that you don't miss out on the chance to secure gains because you were grabbing a coffee or sleeping. They are an important tool as they help you to avoid the negative emotional baggage and frustration that can come from missing out on locking in any gains in a particular move. The final consideration for today is psychological tools and emotional discipline. Maintaining the right psychological mindset when you're trading is critical. It's important to ensure that you're clear-headed before initiating trades. And to help you with this, you can deploy pre-trade checklists that help you to ensure you're following your trading plan and have set a stop loss using a valid approach, for example. This list can be as short or as detailed as you want it, whatever it takes to get you in that right, clear-headed state before you execute your entry trade. Post-trade evaluation after you've exited a trade is also important and doesn't have to be time-consuming. It can be based on an individual trade by trade basis or on a base or analyzing a series of trades. It should be focused on emphasizing the positives of you following your trading plan, not just focused on profit on loss of those trades. As it's the reason for this is it's about reinforcing good habits and discipline to build and maintain your trading confidence. Anyone can have a really good trade that turns bad due to unforeseen events. So you repeat the positives and you assess what needs to improve. You detail why it needs to improve, and then you implement these changes on the next series of trades. So that brings me to the end of this section. As a final word on this, I just want to say each step I've outlined is interconnected. A robust trading plan informs your capital allocation, which in turn guides your position sizing. Stop loss and take profit orders enforce that plan's risk reward parameters, while trading stops help to lock in benefits as the market moves in your favor. Finally, regular reviews and maintaining that emotional discipline we discussed ensure the entire system works as intended. So to bring this all together in one example, I have a case study involving the S&P 500 from earlier in March. So during this period, risk sentiment started to sour at the back end of February, as we can see on the charts. But we had seen a similar move in January, just before President Trump took office. This January move provided me with a focal point for a potential breakdown trade to the downside, below the year-to-date lows, which, as you can see on the chart, is at 5,809, and that was seen on January the 12th. So using the steps I just outlined, my trading plan is to sell a break of 5,809, the January the 12th low, entering a short of 5,805. My stop loss exit would be at 5,835, which is 30 points from my entry, and the short-term high of the limited bounce that was seen after retesting those 5,809 lows, as you can see on the chart. Using a risk reward of 1 to 2, my take profit exit is 5,745, which is 60 points from my trade entry. Using a capital allocation of $1,000, which is 1% of my trading capital, my position size allocation looks like this. 1,000 divided by 30 equals 33 contracts. As you can see from the charts, this trade would have been successful, but only if I had placed my take profit order into the system in advance, as the dip to 5,743, the low, was limited, and the eventual bounce back higher was strong and could have resulted in my stop loss eventually being hit later in the day. However, one point to note, as the trade moved my way below 5,800, I could have also deployed a trailing stop loss strategy that would have protected some of my gains if I hadn't been successful on reaching my take profit target. Now, this is just an example of a profitable position where I have planned my trade and then traded my plan and maintained my discipline well throughout the process. These positives would all be included in my post-trade evaluation to help me maintain my confidence and reinforce the good habits that I've upheld during that process. However, many traders lose money not because of bad analysis, but due to poor discipline. So before I move on to the questions, let's end the presentation by moving on to identify some of the key trading mistakes that are best avoided for traders. Number one, deviating from your trading plan without a good reason. When the emotions kick in, whether you're experiencing excitement after a winning trade or anxiety after a losing trade, you might be tempted to make ad hoc decisions that stray away from that trading blueprint, the plan. This can result in exiting positions too early or too late, over adjusting or ignoring stop loss orders, and entering trades without proper analysis. Remember, your trading plan is your roadmap. It outlines your entry, exit, risk management, and objectives. Deviating from that plan can lead to inconsistent trading decisions, which are driven more by impulse rather than strategy. Number two, overtrading. This happens when you take on too many trades, often spurred by the desire to constantly be active or recover losses quickly. This can provide more opportunities for errors and may reinforce the bad habits that got you into that negative position. It may mean that you miss high quality trade setups as your focus shifts from quality to quantity. And this can cloud your judgment, leading to decisions based on emotion rather than sound strategy. Number three is revenge trading. This is an emotional reaction where traders try to quickly recover losses by taking increasingly risky positions. Remember, no one can take revenge on the market. It just hurts you and only you. Because in this example, it can escalate risk as traders enlarge their positions or widen stop loss parameters, which can exacerbate potential losses. It can lead to impaired judgment, where the urgency to get back in the game can override solid logical decision making, and it can amplify losses due to those emotional responses, which can increase frustration, which can then turn to desperation, which is something that must be avoided at all costs. All of this works to erode trading confidence and your mental well-being. Number four is ignoring your own risk management principles. Effective risk management involves setting stop loss orders, determining position size according to your capital allocation, and maintaining a favorable risk to reward ratio. Ignoring these principles, even just once, can lead to uncontrolled losses, as without a stop loss, a single trade can decimate your account. Overexposure, where trading too large a position relative to your capital, can lead to significant drawdowns. And imbalanced strategies, where pursuing trades without defined profit targets may skew your risk reward balance. Remember, if you break your own rules once, it's likely you will do it again and again as you move forward in your trading. So get it right and maintain those risk management principles. Number five is letting your emotions drive your decisions. I've mentioned emotions and trading many times today. Emotions such as fear, greed, and hope can significantly impact your trading decisions. Why? Because it leads to impulsivity. Emotions may push you to act without adequate analysis. You often will chase trends because you're on an emotional high after a winning trade. It may lead you to chase the market again instead of waiting for a proper setup. Or there's that herd mentality, or FOMO, the fear of missing out, where following the crowd without understanding market fundamentals can result in poor decisions. And then finally, there's over leveraging. Leverage can magnify gains, absolutely, but it can also magnify losses. Over leveraging means risking too much capital relative to your account size. So the pitfall of this would be a high risk of a total loss. A very small adverse move could wipe out your entire account if you're too highly leveraged. It also can lead to false confidence. Leverage trading might give you the illusion of success that leads to taking on even greater risks. Okay, so I've highlighted the characteristics of volatile markets driven by uncertainty. I've highlighted some of the useful risk management tools, and I've outlined a case study example following these risk management tools. And now we've run through the common trading mistakes to avoid and why. Remember, trading is as much a psychological challenge as it is a financial one. By understanding and avoiding these common pitfalls, following a trading plan and maintaining strong risk management discipline, you can preserve your trading capital and build a foundation for consistent long-term success. So with that, let's now move on to the questions.